A stock. A lot of people pretend that they know the answer to that, but they really don't. A stock is a piece of ownership of a legal kind of business, a legal kind of company called a corporation. A corporation is a company, a legal entity that's divided up into a bunch of little bits. Those little bits are then sold out in some way to various investors, and those investors are the owners. Yes, it's true that there's some special interests, that there can be dominant shareholders, but essentially if you own a piece of that company in the form of some shares, if you own even a share of stock, you're a part owner. You might have just a tiny bit of that corporation's, say, factories or whatever, but you still own a little piece of that corporation. Stocks are also known as equities. Essentially, they provide liquidity and they provide ownership. And as I've said again and again, ownership grows and loaning doesn't. Look at this Morningstar graph. Owning something profoundly outperforms loaning money out. The same is true of real estate over the long term. Real estate is another form of owning something. So why don't we put it all in the stock market? Why don't we just invest in stocks? Because we know that over the long term stocks grow. So why don't we just put it all in the stock market and real estate and walk away? And the answer is that the stock markets of the world can be incredibly volatile. They can fall 50% or more in a year. Now in the long run, that will even out and stocks will probably outperform, as they have for the last several centuries. But in the short run, it can be devastating, and people tend to do the thing which is worst for them, which is to sell out at the bottom because they psychologically can't take any more. And that's why we have a diversified portfolio. That is, diversified means we've got a little of everything, including some bonds, because bonds will keep you rich, even if they won't make you rich. But to finally grow your wealth, stocks are a vital component. Thank you. Invest in stocks? That's a question I get just about every day, at least every week for sure. And here's the thing, it depends. First of all, as you can see with this graph right here, stocks have been the money-making engine throughout the 20th century. So if you wanted to become rich in the 20th century, you had to own some stock. Stocks grow as opposed to bonds, which just pay interest. So the value of stocks is that your portfolio can actually grow. As you can see, stocks outperform pretty much every investment. Depending upon the sector, perhaps real estate equaled stocks, but they certainly did fantastically during the 20th century. And all we can say now is that we don't know what the 21st century is going to bring, but we know that it's probably going to be something similar in a generic sense. On the other hand, there's this graph right here. This graph says that when the stock market goes down, it can go down sharp and hard and ugly. And you don't know when that's going to happen. So you don't want to put all your money in stocks, and you want to be able to have a long time horizon. So the first parameter for investing in stocks is, are you prepared to invest at least from 3 to 5 years? 10 years would be better. And the second thing is, are you diversified so that if the market does decline sharply, you can hang in there? A lot of the time, and they are also one of the largest markets out there. People don't realize when they talk about the stock market or the real estate market that bonds actually constitute a major portion of our financial structure. Bonds are essentially IOUs, the same as you had in elementary school. Basically, you need some money, so somebody loans you money, you promise to pay it back by giving them a piece of paper that says IOU on it, and at some point they give it back. The bond market it's made up of hundreds of different kinds of bonds. There's municipal bonds, there's corporate bonds, there's mortgages. As you can see in this graph, there's all kinds of different bonds. They all constitute the same thing. Essentially, they're a variation on the theme of an IOU. Here's a bond. This is a very basic bond. It's a 0% interest bond. It's a promise to repay at a future date. Essentially, back in the history of the United States, they started out backing these with gold, then they backed them with silver, and now they just back them with the full faith and credit of the United States government. But currency itself represents a kind of very short-term bond. So what's principal and what's interest? Well, basically, let's go back to our dollar. If I borrow $1 and I promise to pay back 10 cents of interest on it, so I'm promising to pay $1.10, the principal is this dollar itself. So if I borrow $10,000, I'm promising to pay back $10,000. If I don't pay it back, that's called default risk. But basically, the $10,000 is the principal. The interest payment is what I pay on top of that $10,000 to reward the person for loaning me the money. So that's principal and that's interest. Bonds keep you rich. They don't make you rich. Plan on using bonds in your portfolio as a diversification, a kind of an airbag or